Hello everyone. Hope all of you are safe at your home. Through this video, I'm planning to give you a brief about the amendments which has happened in income tax. That is for May 2020 CA exams and June 2020 CM exams. And this video is applicable both for inter and final students. Okay. The reason why I have not done a video on amendments in income tax because there is no much amendments happened in income tax for this May 2020 or June 2020 exams. All the amendments which we have discussed in the class itself. So still why I've done this video, because many of my students are not convinced that there is no amendment, because they all listen to the news that there is a new budget has come in February or something. So the things the end rate of tax have been changed. All those news they have listened. So they are not convinced when I'm saying that there is no amendments for exams. So first of all, let me try to explain which budget will be applicable for exams, because I can understand your concern, because when I was studying for IPCC and when I was studying for the final and all, the same issue was with me also. So let me explain which amendments or which budget will be applicable for exams. Okay. Whenever the budget announces by the government, it will be announced somewhere 1 month or 2 month before when a financial year starts or previous year starts. The previous year applicable for your exam is 2019-20, right? 2019-20, that is 1st April 2020 and 19 to 31st March 2020. Okay, next previous, I'm not talking about the assessment year, next previous year is 2020-21. Okay, this is not applicable for exam, this is for next exam. Okay, so previous year 2020-21. So budget, this is starting from 1st April 2020 to 31st March 2021, right? So the budget they have announced in, I think, in February. So February 2020. Okay. So what does it mean? February 2020 budget will be applicable for the next previous year. What is next previous year? February 2020. So next previous year starting from the 1st April 2020. That means the previous year 2020-21. So anything they have brought amendment, or any amendment that they have brought in budget issued on February 2020 will not be applicable for your exam. That means for this previous year 1920. So that is applicable only for the previous year 2021. That is the next previous year. So don't worry about any amendments happened in the budget, for the recent budget. Okay. So but still there are some things I have to explain because you might have a confusion about the surcharge rate. Okay, that is the reason why I've planned to give a video on this. So first of all, let me tell you about the surcharge rate. Okay, surcharge rate goes like this: less than 50 lakh, if the income is less than or equal to 50 lakh, there is no surcharge. More than 50 lakh but less than or equal to 1 crore, then it is 10%, etc. Then 1 to 2 crore, it is 15%. Then 2 to 5 crore, it is 25%, and then above 5 crore, it is 37%. This is how the surcharge rate goes. But this is very easy to understand. But you might have a doubt. You might have came across one confusion, that when there is a 112A and 111A income, okay, 112 and 111A income, when these two income comes, how the surcharge rate works? That is the main one main area where which I am going to cover. So let me try to give you an idea about these things. Okay, so for example, your income, including these 112A or 111A, whatever. 111 income is short-term capital gain on which STT paid. 112A is the long-term capital gain on which STT paid. Okay, that is the 112A and 111A. Okay, so when your income, including or excluding whatever it is, when the total income is less than 50 lakh, there is no question of surcharge. But when your income, including or whatever combination, okay, including or excluding whatever combination, it is more than 50 lakh but less than less than 1 crore, the surcharge will be 10%. I'm again telling you that your total income, whether it is including 111A and 112A or excluding 111A and 112, total income is between 50 lakh and 1 crore. So for example, your PGBP income itself is 60 lakh and short-term capital gain on which STD paid is for example 10 lakh. Okay, so your total income is 70 lakh, that is within that limit, within that slab rate, that is 50 to 1 crore. So the surcharge both for the entire 70 lakh, the surcharge will be 10%. Okay. Now another slab is that when your total income is 1 crore to 2 crore. Okay, so 1 crore to 2 crore, it may be including 112A and it may be excluding 112A and 111A. In any combination, if your income is between 1 crore and 2 crore, okay, more than 1 crore but less than or equal to 2 crore, the surcharge rate will be 15%. Okay, 15%. Up to this, no confusion. All this time it will be 10% for the whole amount and 15% for the whole amount. But another thing, when the next slab comes, you have to remember the maximum rate of surcharge for 112A and 111A cannot exceed 15%. There is a problem comes. Okay, so maximum rate of surcharge for 112A and 111A cannot exceed 15%. Okay, remember that. Remember that. Now let's take another slab. That is 2 crore to 5 crore. Your income is more than 2 crore but less than or equal to 5 crore. The surcharge rate is normally 25%. But as I told you that the surcharge rate of 112A and 111A cannot exceed 15%. So you have to understand, when your total income excluding 112A and 111A more than 2 crore but less than or equal to 5 crore. Okay, for example, PGBP income itself is having 3 crore. Okay, so the surcharge rate for that PGBP income definitely is 25%. But your other 112A and 111A income is, for example, it is another 10 lakh or whatever it is. Total income comes to 3 crore 10 lakh, but the surcharge rate is not 25% or 25% on the 3 crore 10 lakh. It is 25% on that 3 crore. But in case of 112A and 111A cannot exceed 15%. So here the surcharge rate will be 10%, because it is only 10 lakh, right? So another combination is that when your total income excluding this 112A and 111A, it is, for example, more than 5 crore, then it will be 37%. Okay, 37%. That means, for example, your PGBP income itself is having 6 crores. Okay, so in that situation, the surcharge rate will be for that PGBP income will be 37%. So last things. Okay, I have given all these things in my textbook. Okay, so you can refer that. And when the total income including under 111A and 112A exceeds 2 crore, so your income, your 112A and 111A income exceeds 2 crores, still the rate of surcharge for that income will be 15%, because as I told you, the maximum rate of 112A and surcharge for 112A and 111A cannot exceed 15%. So you have to understand like this. The surcharge rate goes like this: up to 50 lakh, then 50 to 1 crore it is 10%, 1 crore to 2 crore it is 15%, 2 crore to 5 crore it is 25%, above 5 crore it is 37%. But remember, the surcharge rate for 112A and 111A cannot exceed 15%. Okay, that is the thing you have to understand. Okay, next one, in salary and all, no much amendments, and PGBP, house property, it was not came recently. That is now the deemed let out property. You might have studied the deemed let out property, where you might have studied that when a person owns more than one house property, other house property, at his option, he can choose any one house property as self-occupied and all other house property as deemed let out. Okay, but now it is amended that a person can own to a maximum 2 house property. So even a person has 2 house property, he can use both for self-occupation, no tax to be paid. But if a person has 3 house property, he can choose only 2 house property as self-occupied and 1 house property he must offer as deemed let out property. That is not a recent amendment anyway. So in the PGBP also there is no amendment at all for this exam. But you have to remember there is a right of in case of what we say right of depreciation. Now they have amended that. What do we say? In case of motor car, you might have studied motor car. If it is used for other than running them on hire, it will be 15%. Okay, it will be 15%. But if the motor car, if it is used for running them on hire, it will be 30%. But now it's a small amendment. Okay, it is not a permanent amendment. It is they are providing that if the motor car acquired during the period from 23/8/2019 to 31/3/2020 and put to use on or before 31/3/2020. Okay, so you have to remember that date 23/8/2019 and 31/3/2020. If you purchased any motor vehicle during this period and it is put to use before 31/3/2020, and even if it is not used for running them on hire, their business is not running them on hire, still then the rate of tax will be rate of depreciation will be 30%. That is the only amendment it is came in PGBP. No more amendments in that head. In capital gain also no amendments. Only thing is that cost inflation index for the 2019-20 it is 289, that you might have studied. So no more amendment for that one. And another thing you have to understand, in some class I have not completed my class in my topic in any class. So you have to understand TDS. There is a 194N, new section, that is 194N. 194N, it's applicable for a banking company or a cooperative society, which is giving, which says that when a person is withdrawing or a bank giving cash of rupees more than 1 crore to a person in a financial year, they have to deduct 2% of TDS. Okay, so 194N says that when a banking company giving in a financial year more than 1 crore to a person, then TDS of 2% to be deducted. This section actually came in 1st September 2019. So the question arises, this 1 crore is withdrawn 60 lakhs before 1/9/2019 and 40 lakh after 1/9/2019, but before 31/3/2020. So the question arises whether the provision of 194N will be applicable for that person. So it has been clarified that even though the TDS provision is applicable from 1/9/2019, but the that limit of 1 crore is applicable for the entire financial year 2019-20. So to compute that 1 crore limit, we have to add up the withdrawal before 1/9/2019, but definitely after 1/4/2019. So for the whole financial year, we have to take into account, not just after 1/9/2019. So that is the only amendment that's come in that provision. For some specified class of persons also, these provisions 194N is not applicable. That you can just go through. And one more thing, not that important at the inter level and all, but final level you may just listen. That is, there is a 139A. 139A is applicability of the PAN, allotment of PAN, that is 139A. So 139A, they have inserted a new subsection, that is 5E, which says that wherever the PAN number is required, instead of PAN number, we can quote Aadhaar number. Okay, so it will be have the similar function. So that is the only thing you have to understand. So this match is only for the inter-level students. Okay. Now inter-level student, may stop watching the video, because this is the only amendments is applicable for exams. Okay. All other amendments in the deduction chapter, we have ATEE something we have discussed. Okay. So there is a small amendments through notification and all they have inserted. Nothing much amendments. Okay. So now I think you are convinced because of these budget. These things I think you might have convinced. There is no much amendments for exams, but for the next exams there will be huge amendments because the rate of tax, total things that they have changed it. So please try to pass, pass this attempt itself. Otherwise, it will be very difficult for you, because you will have to catch so much amendments for these amendments for these exams. Okay, whatever we discuss in the class plus this video is enough. Now for the final students, we have already discussed in the class. There is a new 2 sections have been inserted, that is 115 BAA and 115 BAB. That's it. Okay, 115 BA and 115 BAB. The only thing is that 115 BAA is applicable for the what we say any domestic company. Okay, 115 BA is for any domestic company, but 115 BAB is only for the manufacturing company. So 115 BAB gives that a concession rate of tax of 15%, but 115 BAA is 22%. Okay, and plus applicable rate of surcharge and cess will come. But you have to understand this. For 115 BAB, there is a there is a date. Okay, 1/9/2019. They've given a date. So any only the new company which has been set up after that date will be eligible for that 115 BAB. But there is no such date mentioned for 115 BAA. This is applicable for every companies. Okay, so that means whether it is new company or existing company. But remember, very importantly, these are only on optional for a company. They may choose, or they may, they can just ignore that section also. Why they have to ignore? Because if they are opting this section, they will be deprived of so many other relaxation, like what we say of a carry forward losses, so many deduction. Okay, investment legal deduction, so many deductions that you can just go through. I've given very clearly in the textbook, so you can go through that. So that is one thing you have to understand. And I told you that 115 BAB cannot be opted by a old existing company, because that is only for a new company. So there is no question of MAT credit. But in case of 115 BA, it can be opted by a existing company or a new company. So the question arises when a company has a MAT credit, okay, in the earlier years. So the question is whether that MAT credit can be utilized to set off the tax liability under section 115 BA. The answer is no. That MAT credit, they have to lapse. So that is the one thing you have to understand in that situation. And we already discussed the surcharge rate and all. Okay, so next one is the next amendment for the final level is that much amendments is that much only the amendments applicable for that part. Now in the international transaction, okay, international taxation, we have discussed about 92. What is it? Okay, now we have discussed this 92CA. 92CA talks about the secondary adjustment. Okay, I'm not going to discuss about what is secondary adjustment, because we already discussed in the class. Secondary adjustment simply means, for example, what we say, international transaction has been taken place between an associate entities. For example, there is a transfer pricing adjustment has been done. For example, a company A sold some goods to a company B which a company B is an associate entity and which is located in USA, and they priced the transaction for 1 crore. But when the assessing officer, assessing officer applied the transfer pricing rules and ALP rules and all, pricing, there is a difference that the ALP provision, as per ALP, the price should have been a 1.5 crore. So there is an increment of 50 lakh. So it says that 92CE says that excess 50 lakh should be repatriated to India. Okay, actually they are priced for 1 crore, but as per income tax, as per ALP provision, it is not 1 crore. It should have been 1.5 crore. So the company in a company in India is not only that 1 crore should be repatriated to India, the entire 1.5 crore should be repatriated to India. So what if they are not repatriated that 0.5 crore, that is 50 lakh, if they are not repatriated, it will assume that it is an advance given by company A to company B. So what is the impact of that treatment? Every year interest will accrue that advance, so that will also chargeable to income in the next year. That is a secondary adjustment. So the question arises, from which date they have to repatriate. In 92 CE, we already discussed the secondary adjustment may be because of different scenario. Secondary adjustment may be because of sumo to adjustment. That means ASSI itself is doing the adjustment after filing the return of income. So sumo to adjustment. Second one is that by assessing officer and by APA, advanced pricing agreement. Okay, safe harbor rule. Okay, these are all the different scenario where secondary adjustment is required. So under this different scenario, from which date you have to repatriate, because as per 92C it provides that we have to repatriate the primary adjusted amount, okay, the primary adjustment amount within 90 days. But from which date with these 90 days to be computed? That is what I am going to discuss. So when the first scenario, the secondary adjustment because of the sumo to adjustment by the ASSI, these 90 days to be computed from the due date of return under section 139. So if they are not repatriated within that 90 days, interest will be computed for that primary adjusted amount. That interest to be computed from 139 due date itself. Okay, so the 90 days to be computed from 139 due date plus the interest also to be computed from that date only. Next one is that okay, if it is because of the assessing officer order, TPO order, okay, in that situation the 90 days to be computed to be reckoned from the date of the said order, when the when that order is passed by the TPO, and the interest also to be computed from the date of that order. Okay, both dates are correct. Now if the advanced pricing, if it is determined through an APA, advanced pricing agreement, if it is determined through APA, there can be two scenarios. APA has been entered before the due date of filing the return. So in that situation, if it is before APA is entered before the due date of return, the 90 days to be computed from the date of filing the return, the 90 days to be computed. But if it is not repatriated within that day, 90 days from that date of filing the return under section 139, interest to be computed not from the date of filing the return, it is to be from the 139 due date. Okay, so that is the first case. And the second scenario is that APA has ended after the 139 due date, then the the 90 days to be reckoned from the end of the month in which APA has been entered into. Okay, the month of the end of the month in which APA has been entered into, and the interest also to be computed from that date. Next one, if it is a safe harbor rule, okay, if it is exercised by the ASSI as per the safe harbor rule, the 90 days to be computed from the due date for filing the return under section 139 due date, and the interest also to be computed from 139 due date. Okay. And last one, when the primary adjustment to transfer price is determined by a resolution arrived at under mutual agreement procedure under a DTA has been entered in under section 90 or 90A. We already discussed the DTA provision under section 90 or 90A. If the secondary adjustment done as per that 90 or 90A, the 90 days to be reckoned from the date of giving effect by the office or assessing office under rule 44H to the such resolution. Okay, giving effect means OGE. There is a order called OGE. Okay, OGE means order giving effect, because when a higher authority has determined something, it will ultimately communicate by the assessing officer to the assessing. Okay, that type of transaction is known as OGE, order giving effect. because as such it is not passed by the assessing officer. The duty of the assessing officer is just to pass the information or to pass the order which is passed by a higher authority, that is OGE. So here if it is as per section 90 or 90A, if the second adjustment is done, then the 90 days to be reckoned from the date of OGE. Okay, simply understand like this, and the interest also to be computed from that date itself. Okay. So this is the only amendments applicable for May 2020 or June 2020 exam. So don't worry about amendments and all, because I told you.